It's Morning Call, 14th of November 2025. I'm Mark Gardner. Now, tech stocks were hit, and that great rotation that's been happening over the course of the week continue to happen as really December rate cuts looking less likely. We had the probability of them of a rate cut in DEC fall below 50%, and there was a few Fed members that said over the course of the night that there's just not enough data to get a DEC rate cut because the government's been shut down, which will obviously infuriate Trump in many ways, shapes, and forms. But yeah, I mean, I totally agree. I mean, whilst we've seen very good, or some fairly good leading indicators as to the employment market, the labour market potentially softening. We still haven't had it. We need to get that inflation data in solidly in, so we know, because there is a chance, and no one's really said the word because it's a scary word for equity markets and the economy. But if we've got those stagflationary conditions, then we shouldn't be cutting rates. Now, and there was also an analyst at Macquarie that suggested Jerome Powell may be compelled to hold rates steady or indicate the December rate cut would likely mark the end of an easing cycle. So, again, with analysts talking like that, it's not particularly positive in terms of that rate cut argument, because we've got one. We were expecting, the market was expecting at least 3 by December, and it's increasingly looking like the Fed is actually going to hold strong and do its job despite a bit of lobbying for people for the Fed chair job. And Trump's just not going to get his way until at least May. So we are starting to see, again, the S&P and the NASDAQ. The Russell's now in strong sell territory, but the S&P and the NASDAQ are neutral now on the technicals for the daily. We're in strong sell territory, obviously, for the hourly. The Aussie market is in strong sell on the daily as well. We're strong buy for most of the Asian indices and the Euro stocks and the Dow, but that that may change because I think most of this movement did happen a little bit later on in the session, and yeah, most of them probably haven't really had a chance to react. So the SPY's showing a down 1.54 at 86.42, so down 1.54% or 130 odd points. So we will have, we'll obviously start pretty ugly this morning. And well, given the price action in the Aussie market over the last 3 weeks, if this move continues, we've kind of been the leader in many ways. So it'd be interesting to see whether we really go on with the job or not. So yeah, we will obviously be keeping a very close eye on that. The government did resume normal service. I'm assuming it'll start Monday, given that they wouldn't be able to get everyone back to work immediately. But Donald Trump signed it into signed the funding bill, and it all passed largely along Republican Party lines. It was a 43-day closure. The previous record was 34. It disrupted federal services, particularly aviation and travel, and the funding will now be restored through to June 30 next year. So this is literally just, in my opinion, this is just to get the airlines back up and running over Christmas and Thanksgiving, because there would be an absolute revolt if the government basically, I don't think this was an intended consequence of this. And if we didn't have Thanksgiving coming up, I think this thing would push out another 15, 20 days at least, because the Democrats did not get remotely what they wanted. And they tried to dig their heels in, and they probably thought there'd be a deal done a lot faster. And I think the only reason a deal was done was because both sides were turning on their own parties in the end in terms of voters. So it's now become bad for the Republicans and the Democrats. And this circus is going to start again, probably mid-January. And there'll be a bit of toing and froing and a fair few threats. And I cannot see the Democrats not digging their heels in again. So Yeah, so that's probably, we've been doing this morning podcast for about 3 months now. I would say that's the ugliest looking heat map we've seen so far. And this is where, folks, this is where concentration risk is a positive, not a negative. So the huge tech sector and the chip sector and the Mag 7 being such high concentrations of the indexes, both the Nasdaq and the S&P, has been a great positive because we've been able to completely brush over the 500 million things that are wrong with the economy, that are wrong, that are wrong with the labour market, the tariffs, etc., etc., etc. Because the biggest weightings in the indices are very much benefiting from, what is one of about maybe 3 high conviction trades that are on the board at the moment. I think the precious metals trade, the defence sector trade, particularly in Europe, and AI on the long-term basis is really the only high conviction plays on the board. Everything else is screaming overvalued. Everything else is screaming a slowdown in the economy. Tariffs has been proven to be a ridiculous policy. So we're going to, and potentially pushing towards stagflation, which is a nightmare for equity markets and the economy. So, but all of these large sectors like Nvidia, Google, Broadcom, Amazon, Tesla, Oracle, they're making up nearly over half the index essentially, and that's been hidden with that optimism. As you can see, Berkshire Hathaway, they're up 2.13%. For anyone who hasn't, I was asked about Warren Buffett's letter on the COB on Ausbiz the other day, and I hadn't read it, and I went and had a look at it, and I recommend that everyone goes and has a read, because it'll probably be the last time a significant public figure in the investing world, delivers a very common sense, philanthropic outlook and on the industry, and he has a bit of a shot at the industry for basically being too greedy, and essentially the stock markets and their earnings cycles now just incentivizing CEOs to be super greedy and chase short-term goals over long-term goals. But he also talks about a bunch of other things. Really good read. Just highly recommend it. Because it is definitely the end of an era. So 60 years in markets, it's like, that's amazing. Like most people, a lot of people don't even live to that long. He's seen it all. And we also did have Michael Burry is shutting down Scion Investing, essentially. Having a quick read of the letter, he's basically winding it up over the next month, I believe. And the puts that he bought in Nvidia was only $9 million. It wasn't, the massive amounts that everyone was like running around talking about. But he's basically saying that the markets, the way he views and analyzes markets does not marry up to whether the market behaves. And this is the most irrational market he's ever seen, inclusive of the GFC. So so he's calling it quits and handing back the capital. So, and I mean, looking at his performance, he's made a couple of really big macro calls. He's getting a lot of hate on social media, but the fund still performed at S&P average, even despite he's made a couple of really big macro calls that haven't really panned out. And he did make 4,000% for investors in 2007, so 2008, but they reopened the fund in 2013, and the performance has been meh basically since then. But there's a lot, and we're talking S&P net after fees as well, so it's not like he's terrible, but yeah. So but essentially, I guess the main point there is that that he's also a long-term veteran investor that's just going, I don't get this anymore, so the best thing I can do is stop. Okay, next week's earnings. We got the G20 meeting on Monday and Tuesday, day 1 and 2. I'm sure there'll be a bit of a dog and pony show from Trump if he's even going. He'll want to, stamp his authority, or or miss it completely. But there'll be a bunch of backroom meetings. And we've got a little bit of Chinese data, possibly over the weekend. We've got some Fed speakers, FOMC minutes, unemployment claims, and Fed speakers. I would imagine this calendar will populate more as the week goes on, as government employees go back to work, and we'll start to get a little bit of data. I'll keep a really close eye on the data calendar for you guys. And make sure I change that most mornings. RBA minutes in Australia on Tuesday. Wages data on Wednesday. And we got, then the big show realistically was going to be NVIDIA on Wednesday. So we'll get that Thursday morning. So we'll do a big feature on that. We've got a lot of the Lowe's, Home Depot, Walmart, so a lot of the big warehouse retailers as well. That'll probably give a bit of bit of insight into the, into the broader economy potentially. John Deere will watch, one of my faves. Just, grew up in the country, love tractors, and now it's a data science business and AI business. I'm interested in that, so I always watch that. One of our high conviction and doing quite well, similar to Caterpillar. A lot of this automation and AI technology is actually really transforming those businesses, and they're embracing it. We've got BHP on here. I would assume that's just a quarterly update or something. I'm not entirely sure. We've had a fair bit of news out of BHP recently, but interestingly though, copper at these prices is going to start to rival iron ore in terms of the percentage of revenue for BHP. I wouldn't be surprised if we get further run in copper, that we that it actually make some form of announcement that they expected that it will outpace iron ore revenue at some stage. Had a bit of a pullback in gold, silver, copper, and platinum last night, despite the fact the US dollar was lower. I think that move last night it was a bit of a sell everything move, and really it's just more about people trimming broad portfolios overall. So you quite often see the gold miners get smashed on an index sell-off. I think in that April 4th or 4th through 10th, we bought the gold miners down 10% on a day where the index got absolutely obliterated on the day, and the gold mine GDX, and it was a fantastic trade because gold was going up, like the underlying, but the indiscriminate index selling means that if you've got a fund manager who's just following the ASX 200, they've got to sell. They have to sell everything, and they don't pick and choose these days, and that's kind of the downside of not having of just running an ETF is that sometimes it works for you, sometimes it doesn't. Sometimes you'll sell into stuff that's really cheap and you should be buying, which is the advantage of obviously of being with someone like MPC, where we handle these situations pretty well. I've been through every black swan event since the Asian currency crisis in the 90s. I think we've got the most amount of black swan events in the last 30 years than in history. So they tend to be pretty useful to have a cool head for the clients. We are going to have we're looking at pricing up at the moment in the structured investments realm for SOFI clients only. A buy the dip strategy in the S&P 500. Essentially, it would be a 2-year deal, and for buying the S&P futures. But your entry price would be the lowest daily close of the next 6 months. So anyone who's got any interest in that, I will. We're going to send out an email today, but I might put I'll put something in the comments, or you can. You can message me via, DM me at any stage, and have some interest there. And this thing's a really good product. The stats are overwhelmingly in favour of it happening. The post 2011 era, what we call the modern era, with a lot of algorithms at play where we tend to bounce really quickly. This thing's every downside move from 12% pullback all the way to, the larger COVID pullback of about 35. This trade's worked every single time. So if we manage to get a pullback, it's got an incredible hit rate. Basically, I think it may have dropped a couple of percent once in that last decade. So and the hit rate over 30 years is still somewhere around the 80% mark as well. There was only one occasion where you didn't get your where you didn't get you dropped the maximum amount of 22%. So very good one. Watch your inboxes or inquire if you're interested, because we're starting to see the rot set in, I think, here, and we will we'll have to see what happens over the coming weeks. But I'd highly recommend trimming portfolios. We're not getting any more rate cuts here. We got a 4.3% unemployment rate yesterday, 42,000 jobs. That we are now done. There is no chance we're getting rate cuts. And there's a bit of negativity yesterday overall. But where June RBA rate cut was the next one is down to 30% now. So I'm just going to call it, time of death for rate cut cycle for now. Was yesterday's employment number, unless the US slips into a recession or etc., and triggers a bit of a global recession. I don't think we're going to be considering rate cuts moving forward overall. So, which is again not great for equities, given that global equity markets have already priced this in. So yeah. But look, have a great day and a great weekend. Have a listen to Bulls versus Bears this evening, and we'll record the podcast, myself and either Jonathan or Kai, and we will speak again next week.